Greetings, fellow investors. I'm Matthew Cochrane, a lead advisor at Seven Investing, where it is our mission to empower you to invest in your future. We do that by providing monthly stock recommendations to our premium members and educational content that is freely available to everyone. Listeners, today I am very excited to introduce Lawrence Hamtil. Hamtil is a 16-year veteran of the financial services industry, and in 2008, he co-founded his own registered investment advisory, the Fortune Financial Advisors, which serves clients in the US and Europe. He is one of the most entertaining and informative follows on FinTwit and can be found at Hamtil, Lhamtil, where you can find him posting about everything from his problem child stocks to his workout routines. He is an avid gym rat, but even more impressive, he never skips leg day. He blogs semi-regularly at fortunefinancialadvisors.com. Lawrence, welcome to the show.
Hi, Matt. Thanks for having me.
Happy to have you. Lawrence, I think the first time we crossed paths online was because of your work and research on the valuations of global stock markets compared to the US. And just for a little context, a lot of investors will like to point out that global stocks might be cheaper than US stocks, for a number of years now. And as an argument, that maybe US stocks are overvalued. And until you research, that argument never sat well with me, but I could never really place my finger on why. So would you like to explain maybe why there's more to it than just comparing valuation metrics across different countries' stock markets?
Sure. I think what the mistake most people do is they look at aggregate level or index level data, and they say, okay, well, the S&P is at 22 times forward earnings, and MSCI is at 16 or 17, and Europe's at 12, or whatever the case may be. And so therefore, I should go rotate out of the US and buy these optically cheaper markets. And the reality is, what you're looking at is, at least at the index level, is a different mix of sectors, which in aggregate sort of cloud the level of cheapness or expensiveness in the underlying companies. And a good example is emerging markets. So historically, that's been sort of a moving target over time. If you look, I guess maybe 30 years ago or so, it was Malaysia and Indonesia and some of these places in Southeast Asia. And now it's 40% China. So you want to be aware that historical data, number one, is going to be subject to change, and you're not necessarily buying into what you thought you might be, especially when looking at historical data for the index. And then number two, over time, the sector shift has changed. What you look at in many foreign markets is that they're simply not as deep as the US market. So in the US, you have publicly traded companies in just about every industry, from auto retailers and scrap iron to consumer staples and technology. And a lot of these emerging markets, they're heavily concentrated in what I call static industries that whether it's energy or financials, things like that can't be headquartered somewhere else, so to speak. And so those are typically going to be a lot cheaper than, say, a globalized tech company or healthcare company or consumer staples company. And the current iteration of MSCI you have, as I mentioned, a big China weight, and you do have a big technology bet now with those big tech companies out of China and so forth. So the argument is not as clear cut as it used to be, that in the US you should be willing to pay more because you're primarily betting on tech and consumer discretionary and these things, and have a lower weighting to cyclical financials and so forth. But you also want to be aware that you look at these valuations and how much would you be willing to pay to have 40% of your money in a communist country like China, where shareholder rights are, not necessarily what they would be, and there's some liquidity issues and all those sorts of things. And then I guess the second issue with comparing valuations is foreign stocks might be cheaper, but if the USD is still strong, foreign stocks are going to have a hard time for USD investors outperforming the US, if that makes sense. So in other words, you can have a European stock or an emerging market stock that's doing really well in local terms, but if the USD is strong, that stock's gonna have a hard time outperforming its American peer. So that's the currency issue is what a lot of people overlook. To some extent, currency hedging can alleviate this, but then I often wonder what's the benefit then? Because I want a diversified portfolio, and if I hedge the currency, well, then I effectively have something similar to 100% U.S. stock portfolio. So it's just not as simple as what some people may be led to believe, just looking at the aggregate level index and just saying, okay, well, I want to buy what's cheaper.
Sure. So like basically like you have some giant tech companies in China, which were I think most listeners will be familiar with, like Alibaba or JD.com or Baidu, you get Tencent, obviously. You have those like huge tech companies in China where shareholder rights are not what are less than desirable, let's say.
Right.
And in a lot of other countries, you have financials and some big energy companies and some mining companies, and it's just not the same. The sector allocation can look very different, I guess. That
Exactly right. Yeah. What's sort of funny, I did a post on this a couple of years ago, and it was kind of like how immigration impacts stock markets. And I think Russia is kind of a good example. It's a emerging market economy, but a lot of the intelligentsia, so to speak, from Russia went to the US and Israel and founded a lot of tech companies. So the intellectual capital migrated out of Russia and started these companies elsewhere. But what was left in Russia were the companies that I said that are sort of static, that couldn't be transported outside the borders, like energy and financials and so forth. And more often than not, that's what you get with emerging market bets, is these static companies that you're really making a bet on the local economy, the local currency, and so forth. You don't have as much global exposure for the most part.
So would you say, do you think, how would you recommend, or I don't know if that's the best way to word it, but like, do you think most US investors have enough international exposure, or do they need more international exposure?
Well, I might be a little bit of an outlier in my views on this. I think if you look at what's MSCI World as maybe 55% US, 45% foreign, something like that. So a lot of people benchmark to the global portfolio, and that maybe suggests that they should have almost half of their allocation in foreign. Most of my research shows that um, well, at least for the last 30 years or so, the global portfolio hasn't added any benefit, not just in absolute terms, but in risk adjusted terms as well. I think, the Sharpe ratio or risk adjusted return metric has been higher for the US only portfolio for a long time. And that's a function of several things: the higher quality companies, and for the most part in the US, and currency's been strong, and things like that. I'm not opposed to foreign investing, but I prefer to do it in a little more niche way, which is I look at the global opportunity set, and I look at it by sector. And I think, for example, Nestle is a very fine company in consumer staples. It's arguably better than most of its US peers in the consumer staples space. They do business in 150 countries, and things like that. So, that's a foreign stock I'm willing to own, and we do own. Excuse me. Then you've got opportunities in healthcare and things like that. Where I am less enthusiastic would be on things like financials and utilities. Um, some resource companies, I just get the sense that if I'm going to be in those industries, and in aggregate, some macro forces are going to affect mining companies, for example, the world over. They're all subject to the prices of iron ore and things like that. I might be better off with an American company where I'm happy, or at least more confident with the accounting standards, shareholder rights, those sorts of things. So really, it's kind of building a global portfolio with your best ideas in each industry or each sector, based on what exposures you want to have.
Sure, sure. So that makes a lot of sense. Let's shift gears a little bit. So like more recently, I've been running across your bull case for the US defense industry. And with valuations getting a little more stretched in some sexier names, you've got to my attention. Why did defense companies make for good investments?
Well, the I guess for a couple of reasons, and historically they've never really been in kind of like a what you might consider a bubble, so they're very rarely excessively valued. There might be a few explanations for that. Some people object to owning weapons. On the other hand, some people are worried about government defense spending, although both parties seem to have a historical tendency to spend money on it. Very significant jobs contributors to local economies. And it's a skilled workforce that you want to keep employed because you never know when you're going to have an emergency. So historically the government has sort of treated these in a socialistic way, trying to keep this resource, really is what it is, of intellectual capital and human capital that knows how to build these complex machines and systems, keep them busy, keep them sharp, so to speak. Um, just having the government as your primary customer scares away a lot of people. It really limits the growth opportunity set. But in reality, these companies have tended to trade a lot like consumer staples. There's a high degree of quality, a much lower degree of volatility. As a friend of mine once said, who is a subcontractor for government parts, he said the government always pays its bills. They have unlimited resources. And then the industry has gone through a large uh, period of consolidation in the 90s after the Cold War. It's very oligopolistic. Um, I just think there's a lot to like about it. They've become very shareholder friendly. They generate a lot of free cash flow. And it's for the long term, I think these companies are going to continue to do that. I mean, you know, for sure that there's very little chance, probably no chance, that the government's ever going to ask a foreign company to compete for a weapons contract. I mean, it's a natural national security risk. You don't have to worry about a Chinese company, for example, coming in and taking market share from you. So all of these things sort of create these almost impenetrable moats for these incumbent companies. And the weapons are so complex; they take years, if not decades, to sort of plan and initiate the projects and see them through. And oftentimes, the government will just approach these companies and say, "Here's what we want, build it for us." So it's you're going to go through your periods in the desert like a lot of unsexy industries, but for the long-term investors there's a huge track record of wealth creation in the names for those who are patient enough to kind of sit out the periods where they're out of favor.
Yeah, they really seem to enjoy like some unique economic moats, right? I mean, like I mean, you pointed out a lot of them, but like the US government, like you said, they're not going to go to a European country or, much less anywhere else to really like look for like their new like fighter jet for the Air Force or for the
Exactly right.
Army. And so there's limited competition. And then also like the employee base of these companies, right? Don't they have to like go through security clearances and things like that? I mean, like,
Exactly.
can you walk us through like some of these like I mean I know you already touched on some of them, but like walk us through some of the just the economic moats this industry enjoys.
Yeah, so you touched on one, which is the workforce. These are highly skilled laborers. They're working on highly classified um, projects. If you read the book Skunk Works, which is just kind of a fascinating inside history of Lockheed Martin and how they developed the stealth fighter and the SR-71, you get a sense for just how um, tight-lipped these companies are with and how they have to be with their employees, and they want to keep these guys busy because they are a precious resource for the defense industry and also for the government. Now some things are transitioning into space and so forth, and oftentimes for investors it can be frustrating because these companies, they're not even allowed to give details on some of the projects that they're spending hundreds of millions and maybe billions of dollars on because it's a national secret.
Right.
So that can be one thing that turns people away, but again it sort of adds to your moat that these it just tells you that these companies are doing things that it's very hard to compete with. And I think the data show that I don't know however many tens of thousands of smaller companies just gave up after the Cold War trying to get in on the defense spending and they just folded up, and the industry has consolidated. So there's a lot of power with these incumbent companies. And I have every reason to believe that's going to continue. It may not be exactly in its current state. It might not be huge bomber formations or, fleets of fighter jets or Abrams tanks or whatever. But whether it's missiles, satellite technology, all these sorts of things, drones, I do believe that the oligopolistic nature is going to persist just because these weapons are so expensive. It's not like World War II. You're going to be building 50,000 Sherman tanks. So, all of these unique things sort of play to the advantage of these companies.
Is there an argument to be made, like that there might be like a next age of defense companies coming up, like say Palantir, for instance? Like, are these companies, should they be thought of more as like traditional software names and traditional like software platforms, or should they be like, do they enjoy like, and maybe not just Palantir, but other like cybersecurity names that might win large government contracts? Like, is there an argument to be made they might enjoy some of these advantages too in the future?
Yeah, I'm not as familiar with those. I do think though that there is an argument for that, and of course it ultimately depends on how the government treats them, and how they do business with them going forward. And obviously they're going to, the government tends to play favorites, and then it's kind of like,
The
once you
U.S.
get in.
government? What?
Yeah, exactly, right.
What?
Exactly.
No,
So
every contract's fair, buddy.
yeah, right. So, once you get in there though, it's kind of
Right.
like, how do you get out of that relationship? And maybe you can't. And I think Booz Allen Hamilton is another example, right, of a contractor that does a lot of work for, not just for defense, but for the government as a whole. Um, it is an interesting part of that's coming up, and it's not exactly the same dynamics as weapons and so forth. But I do think you have a good point that they could be the next generation that sort of shares a lot of these things with the defense primes like Lockheed and Northrop and so forth.
Sure. Um, what about like, I mean, have you followed like the Jedi contract, which Microsoft won, and then Amazon's contesting it? How much will like the if whoever ultimately wins that, and I'm not to say it'll be Microsoft or Amazon. I mean, it's a new administration. I have literally no idea, but like, will that help? You think the way that government contracts work and sales work, like that'll help like that company win a lot more future contracts with the government?
That's what you'd think, although like I said, the government likes to practice socialism. So and often my understanding is in that space, they want to keep a healthy enough competition. So they'll probably allow one company to win one contract and then the next company to win another, as long as there's, not totally significant differences that would, lead you to one way or another. It seems like the government likes to spread the wealth around a little bit.
Sure.
And, but that's, I mean, it's kind of like they want to keep all the piggies fed, so to speak. So
Right.
I don't think that that's a bull or bear case for one or the other. I think it's a bull case for the group of companies, if that makes sense.
No, absolutely. So speaking of Microsoft and Amazon, we were recently DMing, which kind of like the catalyst for this podcast conversation. But like what we were talking about big tech a little bit, like and you even tweeted this morning out that like Facebook investors complaining about like its valuation and how it might not be fair. And this struck a little close to home, I'll admit. Might like reminded you of like your tobacco stock shareholders, like consistent for years have been arguing that valuation is too low. So like, I mean, do you think big tech, is it overvalued? Do you think it's a bubble? Like, how do you look at those big tech names?
Well, our clients, and I think I myself personally own a lot of these names, so I just don't tend to talk as much about them, primarily because everybody talks about them, or it seems like it. Google and Facebook. I mean, I think Facebook's probably one of the cheaper of the big tech names. Google was recently, well, until recently, was looked pretty cheap. I think since it's run up lately, it's gotten a little more expensive, although I think it's still reasonable. Microsoft as well, although I'd probably consider that closer to fairly valued. Of all those names, Apple's the one that is the most puzzling to me. It depends on what you think the future of the company is, right? I mean,
Sure.
if I'm not mistaken, it's something like 80% of the revenues are still hardware. Um, there's some people argue that, and the multiple has what effectively doubled or so over the past 12 months. So almost all of the shareholder creation has just come from multiple expansion, if I'm not mistaken. What was it? A low teens to mid teens multiple for much of the last decade. You know, it was a very cheap stock, especially on an ex cash basis. Um, you know, I know there's a popular argument that it's a consumer staple stock or a utility or something like that. I just don't find that a compelling argument. How often do you change your phone? It's every few years, something like that. It's not it's not like the Nestle chocolate or the General Mills cereal in your cupboard. Um, it's a fine company, high returns on invested capital, and a lot of shareholder friendly policies. They're very well run, but it just remains to be seen whether they can pivot to a more recurring revenue basis and get away from purely hardware. The whole thing about the uh, going into the automotive business sort of scares me. I don't know if they can do that or even if it's worthwhile for them to do it. This is a whole, maybe this is a topic for a future conversation, but I've recently been sort of fascinated by companies that reach a certain point and then they have to shrink in order to grow again. And I have to wonder if some of these big tech companies, if maybe that's not a recipe for success going forward. I mean, they've gotten to be so big, they've got their fingers in a lot of different operations, and I don't know exactly would they be better off with a little more focus. Maybe shareholders don't want to, they want to own some of those businesses, but not the whole thing in aggregate. Um, and I don't know, it just seems like something that's going to be relevant to this particular group of companies in the future.
That's an interesting thought, and it's going to take this conversation like a place I wasn't really anticipating. But like you would also think too, it would a lot of that would get the government off their backs, which might be like their biggest impediment right now. Like all of them like face certain like you see future risks there with like government regulation or antitrust concerns or whatever it is. And if they were to, as you said, like spin off maybe certain divisions or things like that,
Right.
you lose some synergies. But if it just to alleviate that problem or potential problem to let the valuations grow a little bit, you wonder if it would create some shareholder value.
Yeah. Yeah. And it's I've recently been reading a lot about railroads, for example, and it's just kind of interesting how they took the approach of doing away with low profitability lines and really focusing on just doing a couple of things really well. And that was the recipe for success in what was a very troubled industry. These companies aren't troubled by any means. I'm not meaning to suggest that, but just the concept of you got to this point by doing a lot of things well and being smart capital allocators, acquiring these platforms, especially in social media. And, the valuations for the most part don't reflect a lot of trouble on the mind of investors. But I just have a suspicion that the next decade is going to look a lot different from the prior decade, and for these companies to continue the level of success, I do wonder if that maybe isn't a way forward for them as they evolve. And it'll be interesting to see. It always scares me a little bit when these companies that generate so much cash. I mean, they've certainly been buying back shares, especially in Apple's case. You always wonder, though, if that causes a little bit of ill discipline on the capital allocation side and what they want to do. Are they going to be empire builders? There's a few open questions. So even though they're great businesses and valuations are for the most part not entirely stretched, there are some open questions out there for them.
If you were going to question one of those companies' financial discipline, which one would it be the most?
Well, it seems to be Google is the popular one there, and it hasn't really. It doesn't seem like it's been a real anchor around their neck, but I think
they've done all right. They've done all right.
Yeah, but they could do better. That's for sure.
Sure. So going back to Apple, and for the record, I mean, I agree with you. It's actually it's still the only big tech company name I don't own. But let me push back just a little bit. What would you say, like you're talking about 80% of their sales are in hardware, which is true, but what would you say like to the argument that like the hardware is how they push their software, which is the real, yes, like customers replace their phone every 2 to 3 years, but rarely, or a lot less rarely, switch platforms from like say iOS to Android. Do you see merit in that argument that like it's more of like almost like a hardware is like their distribution for their software?
Sure. No, I think that's true. The question is, how much is that worth? And I guess, and I'm not a tech guy, so I'm a little bit out of my element here. I primarily, tobacco and airplanes and things like that. So take what I say about the sector with a grain of salt. But, I look at it, and I look at a company like Microsoft, and I feel like that company it's more reasonable trading at 30 times earnings versus Apple because of what they're doing with the cloud and so forth. And I just think they're one of the premier businesses in the world. Apple's a great business too, but valuation wise, it's just hard for me to think that while your argument does have a lot of merit, how much is it worth? Is it worth 30 times or 35 times or maybe more like 20 times? And I guess I would feel more comfortable with their current business mix and given, like you said, the fact that a lot of these platforms, I mean, there are selling that package, of course, and people are willing to pay a lot more for it than say for competing hardware and so forth. But it seems awfully close to being priced for perfection. A lot of things have to go right for that to continue to be the case. And I guess the other question is maybe like, well, how do I want to say this? If you look at Apple, was it mispriced for most of the past decade?
Sure.
Why is it now worth 30 times earnings or whatever the current multiple is? I mean, what has driven that for the most part? We know it hasn't really been from much organic growth. If I'm not mistaken, for much of the last 5 years, in aggregate revenues and profits really hadn't grown all that much. It's certainly not compared to the other big tech companies. So, that I guess maybe that's my pushback to your pushback is what's the
Sure.
right narrative? Was it mispriced for so long, or I guess it's just going to be the bull versus bear case for that stock,
Sure. No, it has had an incredible run since I guess Buffett. It almost seems like Buffett timed it pretty well there.
Yeah.
Like a few years ago, but it's had an incredible run since. There's no question about that.
Yeah.
So you've brought up tobacco a few times, and I know you invest in tobacco stocks. You tweet about them, about the industry a lot. Like, what do you say to like people who object to investing in tobacco stocks on the premise that it's not good for society?
Well, I guess it really is sort of how you define that, and I'm not trying to be flippant by any means, but we look at really the nicotine pool, and it can be combustibles, it can be oral nicotine, it can be vaping and so forth. And that's really kind of what we're looking at here is, and probably the future of the industry, not just cigarettes, although that's certainly been the most profitable for a century, really. It really kind of depends on how each person frames this. So if you're not okay owning the company that manufactures cigarettes, for example, Are you okay with owning a company that sells them as part of its business, like a Walmart or a C-store, anything like that? The companies really don't need your money. In fact, they give most of their profits back to investors. I think Altria, for example, returns 80% of their profits to investors via buybacks and dividends. So by not owning it, you're not really harming them. I mean, the theory is supposedly that by not owning these stocks, you're raising their cost of capital, but it's not like owning a bond where you're directly loaning them money. So we have to ask ourselves, okay, are we, by not owning them, are we really doing anything that productive? You could also take the proceeds from your investment and you could allocate it to different groups or researchers or whatever that might, do something to combat the industry, for example. There's a lot of different ways that you could frame the argument. Uh, but the way I put it with clients is they tell me what they want to exclude. For the most part, most investors just are okay with whatever's going to make them money and help them achieve their goals. There are obviously a few people who are going to object to owning certain industries, and that's perfectly fine. We can build around it, but I always just want people to think, how far do you take that argument? You know, um, why not do something else with the money that you get from these investments if they're helping you accomplish your goals? There are a lot of things to like about the industry, as they have high competitive advantages. The regulatory barriers really insulate them against competition. They have ridiculously high profit margins because they don't have a lot of competition. As I said, historically, I think it's been the best performing industry, for a variety of reasons. I guess each person has to answer that question for him or herself as far as, if I don't own these companies, will I be satisfied with perhaps a lower overall return in my portfolio? Can I make up for that somewhere else in the investment world by owning some other companies? I mean, they certainly haven't done very much the last couple of years. So people who refuse to own them haven't really missed out. But, there are some unique characteristics that I think in a balanced portfolio, they provide some positives in aggregate. So yeah, it's not a simple question to answer.
Sure, sure. So what would you, I mean, you touched on, they have very high margins. Let's take the moral part out of it. But for the investment case, I mean, you said they have high margins, high dividend yield, no question about that. It's probably, if you want a high dividend yield that's well covered, it's hard to find another one that matches, the dividends that some
Especially
of
in
the.
this environment. Yeah.
Correct. Yeah, for sure. But what would you say, like, if people point out, like, it seems like, maybe I'm wrong here, I'm out of my element now, but like the global smoking population is declining. Like, what would you say to the future of the industry?
Well, I think that you kind of have to frame it again like a kind of a nicotine pool versus smoking. So a lot of as I understand it, a lot of the reduction in smoking, at least the last couple of years, was crossover category movement to, say, vaping or oral tobacco. Uh, I think there's still a demand for nicotine. There may not be for cigarettes. And Philip Morris International has done a very good job of being ahead of the curve here, and they've developed their heat not burn device, which is you get your nicotine and all of the different things that people enjoy about smoking, the habits and the oral fixation and so forth that people associate with smoking, the social aspects as well, but without a lot of the negatives from, basically inhaling the smoke and so forth, the things that are carcinogenic, I guess, or poisonous for the person. So I do think there's going to be a demand for nicotine going forward. um, I think, what is it? I think it's like a billion smokers in the world. So that's 1 out of 7. Granted, a lot of those are in China, which is a sort of a closed market for tobacco companies. It's mostly from the state-owned Chinese tobacco company there. But I think there's still a very large profit pool for nicotine consumption. And just the fact that it's regulated and you've got a handful of players, that ice cube can take a long time to melt, and there's a lot of money to be made along the way. And I mean, if you compare it to other industries that are still growing in aggregate, um, whether it's automobiles or things like that, where there's so much competition, those have really proven to be, for the most part, inferior investments. I guess I would prefer to, was it Peter Lynch who talks about in an industry he prefers an industry that's growing slowly only if he can't find one that's not growing at all,
Right.
because
Sure.
that's where you'll
Sure.
find your big winners.
Right.
So that's my logic anyway.
Sure. Makes sense. Lawrence, where can people find you if they're interested in following you?
They can find me on Twitter at L Hamtil, LHAMTIL. They can follow the blog at fortunefinancialadvisors.com. We try to blog a couple times a month, although I've been not very good at doing that on a regular basis. My brain's been a little empty for a while, it seems like. So yeah, for the most part, if you're interested in boring industries and deadlifts and squats and so forth, feel free to follow me and just watch an old man try not to kill himself sometimes at the gym.
Fair enough. Well, thank you very much for joining us today. I'm Matthew Cochrane. We're Seven Investing, and we're here to empower you to invest in your future.